welcome to the June episode of Fintech Firebrand. I'm Virginie O'Shea, founder of Firebrand Research, and I'm here to chat to you about this month's finreg and fintech news. Now, I can't start the episode without mentioning the biggest news, I think, this month has been the Securities and Exchange Commission's actions within the realm of cryptocurrency. Earlier this month, it took actions in the same week against both Coinbase and Binance. So those were two long-planned, evidently, actions against the two of the largest players in the cryptocurrencies market. Now, they came at a time when, during that week, a bill was proposed by two House Republicans, Patrick McHenry and G.T. Thompson, about regulating crypto, which would actually grant the purview to the CFTC, the Commodity Futures and Trading Commission, rather than the SEC. And the bill creates a new asset class called digital assets, and including something called restricted digital assets, which are securities, but they should not be classed as securities. Something somewhat complex, but the bill would create this new asset class to ensure that the SEC, though these are technically speaking securities, these digital assets would be either digital commodities or restricted digital assets. However, there are some issues with regards to the classification within the bill. There's going to be a lot of debate, no doubt, over the coming months about this idea of restricted digital assets and where the line is drawn between securities, tokenized securities, especially in digital assets, and how that works. There are certainly some qualifications that they'd have to make. They're trying to sidestep the Howey test, which is the way that traditionally the SEC determines and other regulators determine whether something falls under the securities bracket. But this is a way of potentially sidestepping that. It's interesting to see that these proposals came out during the same week that the SEC takes these actions. Obviously, the SEC is dealing with a lot of things via enforcement at the moment, and the two actions against Binance and Coinbase are obviously being fought by the companies in question. No doubt there's going to be a number of different actions and follow-ups over the coming months with regards to the court cases related to both of these actions. There's a lot of focus on that. The actions relate to the fact that the SEC determined that both were offering unregistered securities, had not registered properly with the SEC, and also there were some other things related to compliance requirements, particularly with the Binance incidents there, and the idea of not meeting basic compliance KYC checks as well that are required under law. So very, very complicated in many ways. But certainly a lot of interesting things going on within crypto. We may have hot weather here, but certainly crypto winter continues on. In Europe, interestingly, we had the markets in crypto assets regulation, MiCA. It's been wending its way through the regulatory process, as I probably mentioned last month. Now we finally had it published in the official journal of the European Commission, or the European Union, which is the official entry into force in June for the regulation. So it's set in stone now. We've got the regulatory text, level 1 coming into force. Obviously, as I've mentioned before, regulatory technical standards are still outstanding. We still need to wait for those from ESMA, who'll be working away on them. But certainly a lot of activity. I think crypto hasn't been this busy for a little while. So very, very busy month to begin with. Another big topic I've been talking about for a little while is operational resilience. We had an interesting incident this month. We've had a few over the last few months. But we had a relatively significant outage for the SIX Swiss exchange. It's worst outage it's had in over a decade. It was offline for quite a while earlier this month. That's something that a lot of the regulators across Europe are worrying about, a lot of the regulators in other jurisdictions, including Asia and the North American markets as well. we are thinking about how to make our systems much more resilient, financial market infrastructures being the most important there as a hub of activity for capital markets. So certainly the news comes against a background of increased focus. So it will be interesting to see exactly what caused the outage. The exchange has said that it is not to do with cybersecurity, so it must be some sort of maybe an upgrade or something that has caused the outage, or something internally with regards to systems. Obviously, the DORA, the Explorer, the Digital Operational Resilience Act, requires much more transparency about outages. So although it hasn't entered into force yet, we will see much more clarifications coming from financial market infrastructures when these incidents happen. And as I say, we've seen a number of markets have similar problems over the last couple of years. We can only expect them to increase, given we've also got a lot of interesting discussion at the moment about climate risk. According to a lot of the climate scientists, there's been a lot of discussion over the last 2 weeks in particular about the El Nino effect, the rising temperatures of the sea, and the increasing risks related to extreme weather. We've obviously seen in New York something that makes it look like Blade Runner, with the fires from Canada, a lot of smog, a lot of smoke coming into the city, and a lot of the other North American states were affected as well. Certainly, that is a very visible indicator of the increasing challenges related to climate risk, climate security. There's been lots of interesting debates within the industry over the last few months, and actually, to be fair, the last couple of years about climate risk and how better to measure it. Certainly, there are a lot of flaws with regards to how we're measuring it currently, which means that we aren't adjusting our systems maybe enough to take into account the impact, particularly in areas like commodities markets, derivatives based on commodities. If we are going to see increase in extreme weather, we may see more crops being wiped out. We may see lots of more risk to life, more disruption. We also may see many more outages caused by data centers overheating, as we saw last year. So certainly a lot of very worrying things to look at, but something that's top of mind for a lot of people at the moment. Now, talking about climate, I can't not touch on the topic of ESG. Again, we've had some more progress in Europe with regards to ESG finreg. There's many complicated moving parts to the incoming sustainable finance requirements. Interestingly, there's been a lot of campaigning on the part of buy-side firms to try and get more regulation on the data side. This month, we saw clarification that ESG ratings providers offering services to investors and companies will be authorized and supervised by ESMA. This is to ensure their services are of high quality, they're reliable. And obviously, if you are basing a lot of your judgments and your investment decisions on that data, then you need it to be as reliable as possible to avoid greenwashing. So certainly this is a win for the buy side, because they have been campaigning for much more oversight in this space. It doesn't look like it's been extended fully to all of the data providers yet, but that could be incoming. Certainly that is progress. I'm sure there'll be a lot more discussion on that topic as well. ESMA has been out and about publishing a lot of different reports related to greenwashing and sustainable finance. They launched, the European Commission launched a 4-week feedback period on its first set of sustainable reporting standards for companies earlier this month as well. So that's something they are looking for the industry to reply back before the, I think it's the 7th of July. So that's another sort of key area for the CSRD, not CSDR, not to be confused with the Central Securities Depositories Regulation. That's CSRD is looking at corporate sustainable reporting. So certainly that's something that we will see much more activity on in the coming months as well. Now, I don't know how many times I've had discussions about the move to T+1 settlement over the last few months. Certainly, you'll have seen me out and about talking at various events on the topic. There's God knows how many papers out now on the topic, and lots of different opinions and concerns have been raised across the globe in terms of preparedness. May next year is creeping ever closer. We've got less than a year now, and certainly there are a lot of worries about the level of preparedness in particular contingents, particularly internationally, and within the buy side with regards to the deadline. Now, certainly that's something that we have to think about in the UK, because we are also providing feedback to the government at the moment with the Accelerated Settlement Task Force. For some reason, the Australians have decided to join us, so they are now also the Australian Stock Exchange ASX is looking for feedback from key stakeholders on a potential move to T+1 in that market as well. You think perhaps they may want to sort out some of the issues they're having with regards to upgrading their CHESS system first, but certainly it is something that there's going to be a direction of travel for all of the different market infrastructures across the globe in shortening the settlement cycle. Once one moves, nearly every market begins to consider it. So certainly that's it's already started happening. We expect that that feedback period to be relatively short, much like in the UK. So it'll be interesting to see when they make the decision to move. Is it next year? Is it the year after? Is it the year after that? We'll see. On the fintech side, we've also seen some interesting moves talking about financial market infrastructures. NASDAQ this month bought Adenza, that focuses, it's a vendor that was the combined entity from Calypso, which has been big in the derivatives world for quite some time, and also AxiomSL, which was big in the sort of risk and regulatory reporting space. So interesting to see another acquisition by NASDAQ. It has picked up quite a few different assets over recent years. We're at Firebrand, we're producing some reports every year on what's going on within the FMI space. I have sort of very interesting timelines of all of the acquisitions these different FMIs have made, and NASDAQ has certainly been one of the most active with regards to fintech investments, though it is not alone. There are certainly many other FMIs out there that are just as acquisitive and have spent a lot of time investing in various areas. If you want to look at the CSD realm, Euroclear has been investing in many different fintech startups, particularly in the green space within the ESG. So it's interesting to see how these various different entities are evolving over time. I think everyone and their dog is at the moment is investing in fintech. So it's not just the FMIs. We're also seeing some of the large custodian banks continue to invest in their own technology stacks. State Street being one of the ones that's picked up lots of interesting strategic partnerships out there and strategic investments in some of the collective platforms like Access Fintech as well over time. So the fintech world seems to be getting a lot of boost from large players in the market. Whether those are successful in the long term is interesting to see. Hopefully they will be, certainly for the success of the industry overall, but definitely expect to see more FMI investment in this coming year.